Hey everyone, and welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. For those joining us for the first time, I'm responsible for identifying and analyzing digital asset and blockchain opportunities for Arca's funds. As part of our research, my team and I examine token prices and the market events that act as catalysts for price change. Based on our research and market events over the past week, here are some notable token price moves and what we think drove these moves. As a reminder, this commentary is not intended to be investment advice, investment research, or an investment recommendation. Please consult your investment professional for your own circumstances. Well, welcome another week with you guys. We are officially at the end of October with Halloween tomorrow, and we have 2 months left in the year. That went by quick. Obviously, we have 6 days until the presidential election. The race has just been intensifying day over day. Everyone is trying to bet on the outcome with, the regular market, different stocks going up and down based on that. But more interestingly, I guess this week we saw Bitcoin get really close to all-time highs and just barely touching 72,000. And hopefully we see this continue to run. ETF inflows have continued to be super strong since last week. And then on the flip side, we've also seen some other interesting things. Consensus, one of the largest crypto groups, has laid off 20% of their workforce. DYDX also laid off 35%, and Kraken announced that they laid off 15% this week. But I have a lot of tokens to talk about today, so we should get started. First up, we have Synthetics. So if you're not familiar with Synthetics, they are the decentralized futures exchange synthetic trading protocol. So they released a governance proposal yesterday that to acquire Quenta, which is the largest DEX utilizing Synthetics protocol. Synthetics is best known for, if you're not familiar with them, pioneering DeFi. It's really like this pioneering DeFi project. They're the first one to have used liquidity farming, essentially, or yield farming to bring users to their platform, which is when they gave tokens away in order for users to use the platform. The project has also not really seen a lot of usage in recent years, especially with the rise of other big projects like DYDX, like Hyperliquid. They now only account for about 2% of decentralized derivative volumes. But it seems like they've been trying to really reboot themselves. They launched something called the Synthetics Reboot a couple months ago, and that basically overhauled their entire governance system, simplified it down to streamline their operations. They didn't even have a foundation set up. So there were some things that they were trying to get done there. They're also promising at some point now with this new reboot that they're going to have on their new roadmap a redo of the Synthetics token, or the SNX token. Now, Quenta was originally incubated and spun out from Synthetics in 2020. If you have not been in the space that long, but I do remember them spinning this out. So basically, according to this blog announcement, though, from Synthetics, they basically said, the operational overhead of maintaining the Quenta exchange has become really burdensome. And it's basically leading to the acquisition proposal that came out yesterday. So Synthetics has proposed swapping about one Quenta token for 17 SNX, which is going to value the protocol at roughly $13.2 million. And the Quenta exchange, once it's kind of come under the house of the Synthetics, is going to rebrand to Synthetics. So everything is all under one house. Synthetics didn't really move much on the news. It's only up about 2% for the week. Interestingly, though, Quenta was actually trading at about 16 million valuation before the announcement, and it traded down to the new valuation that's being purchased at 13 million. Okay, next up, we're going to talk about Jeto. So Jeto is Solana's largest liquid staking provider. And that, I know we've talked about liquid staking derivatives, but you're kind of new to crypto or this show. Liquid staking is when instead of just saying in a proof of stake system like Ethereum or Solana, instead of saying, hey, I'm going to take my tokens, I'm going to stake them in the protocol and use that to provide security on the network and earn tokens that way. Instead, I am going to stake the tokens through a provider such as Jeto or on Ethereum. Lido is the big one. And in return, you get a derivative asset that represents your staked amount in the Jeto token. So that's why it's called a liquid staking token or liquid staking derivative. But anyway, Solana's largest liquid staking provider, Jeto, introduced a governance proposal this last week to route 3% of all revenue earned from MEV to the DAO. So, and also with a small split to node participants. So MEV stands for maximum extractable value. If you're not familiar with it, this is a fun crypto term, but basically MEV is the extra gas fees that nodes earn when they route or prioritize high value transactions at the top of a block. So, and this is very technical, but for some people, if they are trying to essentially kind of, do something where they're trying to avoid front running, or they're trying, they want to execute a certain transaction in a certain amount of time, they might pay more to make sure that A, their transaction is included in the next block, and B, that it's prioritized really high into the block. And so that's known as MEV. MEV on Solana actually ends up being super high because the fees are super low. And so a lot of people find that there is value in paying for those MEV. So most of actually what Jeto's revenue is comes from these MEV tips. And you think of them like a tip. You're paying somebody to basically give better priority to your transaction. Again, they make a lot from this part of their business. Funneling the revenues back to the DAO, we always think this is good, right? This is essentially the first step in getting tokens or getting revenues back into the hands of token holders. Currently the Jeto token, the JTO token, is really only used for governance. So eventually this would be a great feature. However, running the math on this, the DAO only makes about $8 million annually based on the plan. From this specific 3%. And this figure is really dependent on a couple of factors that are kind of outside of Jeto's control, such as the price of Solana and the high usage of the Solana blockchain, right? If either of those dips, then you end up kind of with this flywheel effect where the revenues also come down at the same time. I don't anticipate this happening actually anytime soon, because at the end of the day, Solana usage has been super high. I think this is something that's definitely here to stay. A lot of folks haven't really paid attention to this yet, but it's a really positive step for a DeFi protocol to go in this direction. So anyway, Solana though, it's up 8.3% for the week on this news. Okay, next up, we're going to talk about Nosis. So Nosis is the prediction market turned DeFi product suite, Ethereum-based project. They announced this last week that they are going to launch a venture fund seeded with $20 million of capital from Nosis, the company, and another $20 million from outside LPs. According to the announcement, the fund is going to invest in real-world assets, crypto infrastructure, and payments rails. So that's a big focus of theirs right now. Nosis has made in the past about 60 investments beginning in 2019. And this mostly, by the way, if you're not familiar with the history of Nosis, came from their very sizable ICO proceeds. So back in 2017 or 16, they raised a very large ICO. It was large at the time, but because it was all in ETH terms and Nosis managed to hold onto all of that ETH through the last cycle, this ETH was invested prior to the 2017 run-up. ETH became their ICO holdings at one point topped like 400 million for a small startup company. So part of kind of what they did is like treasury management and managing those funds. They also decided that they should be investing in some projects as well in the ecosystem. Again, if you didn't really pay attention back in 2020, 2021, Arca did, call Nosis out publicly on kind of some of their uses and the fact that their GNO token doesn't do so much. And they have done a lot. In the last year, they have done a token buyback. Not sure it's made a huge impact on the price of the token. And I guess now that they're actually trying to, piece out some of their businesses. They also recently this year spun out what's called Cow Protocol, which is their DEX, and also Safe, which is their Nosis Safe wallet, which is a smart contract wallet that has seen a ton of adoption. Anyway, so the newly formed Nosis VC is going to be a totally new venture, and it will continue to build out their presence in the space. Nosis is up 11% on this news for the week. All right, last up, I'm here to talk about Grass. It is the new airdrop of the week. I know you guys are probably sick of me talking about these, but this one has been pretty interesting. So Grass is actually a DePIN project, which it stands for Decentralized Physical Infrastructure Networks. And this DePIN projects kind of come in the same vein as like Helium, Honey or Hive Mapper have been kind of the other big ones, but basically decentralizing like really large industries that have been, either network or really tech, very, very computational heavy in the past. So Grass has been around for about a year now. They launched on Monday their long-awaited Grass token. The airdrop was the coolest part, I think, about the airdrop was it was super widely distributed. Over 1.4 million wallets have so far claimed the airdrop, which is massive, by the way. Usually airdrops, if you get 200,000, that's amazing. Over 1 million really, we're talking very widely distributed. Now, of that 1.4 million, that's about 10% of the total supply, and it's gone to all the early users of the network. So a quick TLDR on what Grass is. They allow users to sell their unused internet bandwidth for web scraping in exchange for Grass points, or now what are known as the Grass tokens. Companies traditionally buy this type of like web scraping data information. They usually buy it in bulk. Usually they do it without a user's permission. And so the cool part was what Grass is doing is they're like, well, why don't we just pay people to do this, and then we can keep big companies from just coming in and web scraping. They actually have to pay for the data sets, and the data sets may actually be more useful because we're paying the customers for it instead. So very cool. The Grass token is going to be used for governance, also for staking to provide network security, and eventually the goal is that it will be used to pay for transactions within the network. Initially, the token, what was interesting about this is this project listed initially, it listed at about $1, and the token traded down to like 60 cents and on Monday morning. But it has since traded back up to 95 cents. And at one point yesterday, it was at $1.04. So, and it's now up about 17% for the week. All right, guys, that's all I got for you this week. I hope you enjoyed our insights. Tune in here again next Wednesday at 1 p.m. Pacific to hear what's